Good morning. Thank you everyone for coming to the first session of the Tax Policy Colloquium for this year. I'm Professor Leandra Letterman. I am the William W. Oliver Chair Emerita in Tax Law here at Indiana University Maurer School of Law, and I'm the host of the Colloquium. Now let me go ahead and introduce Professor Sarah Lawsky. She is the Stanford Clinton Senior and Zilpha Kilbride Clinton Research Professor of Law and Data Analytics Advisor at the Northwestern Pritzker School of Law. She teaches or has taught federal income tax, corporate tax, partnership tax, tax policy, tax deals, and contracts. Her research focuses on tax law and the application of formal logic and artificial intelligence to the law. Prior to joining the Northwestern Law School in 2016, she taught at UC Irvine School of Law and George Washington University Law School, and as an adjunct in NYU's Tax LLM program. And before she began her teaching career, she practiced tax law in New York. She has a BA from the University of Chicago, her JD from Yale Law School, her LLM in tax from NYU School of Law, and her PhD in philosophy from UC Irvine Department of Logic and Philosophy of Science. And today she's going to present her really interesting article, Reasoning with Formalized Statutes, the Case of Capital Gains and Losses. So with that, Sarah, the floor is yours.
Thank you so much, Leandra. Thank you so much for inviting me. I'm really excited about having this opportunity to talk to this group and to hear your thoughts about this project. So for this project, really builds, to my surprise, I will tell you, ended up building a lot on my previous my previous work. And what I'm looking at here is, and I'll talk about this more, basically I'm very interested in formalizing statutes, the best way to formalize statutes, how that lets us reason with the statutes. And in this situation, the formalizing the statute, to my surprise, led to a cliff that was hidden in the code. We're going to come back to this picture, but this was kind of my very surprising discovery that this is not why I started writing the paper at all. All right, so let me talk about how this project started and how I was very surprised to find out myself months into the project that it was about computational reasoning. So this project started when I was teaching about capital gain. And there was this definition of net capital gain. Net capital gain means the excess of net long-term capital gain for the taxable year over net short-term capital loss. It includes all these other terms, and they all have excess of in them. This phrase excess of, the excess from the losses over the excess. And I was just having a really hard time developing intuitions about the capital gains and loss statutes because excess of required reasoning by cases. I didn't have a grasp on what those words meant. I didn't have any intuition about them, and it was all over the place. And so the genesis of this project was actually defining and understanding the term excess of. That's what I thought that this project was about. So in this talk, I'm going to start out by talking about excess of, because that's how this started, and develop some intuitions and rules around that term. I'll talk a little bit about what's at stake with capital gains and losses, including the treatment of net capital gains when capital losses can be used. I'll discuss whether it's a drafting error, but definitely a drafting oddity that relates to that cliff picture that I showed you. I'll talk about the relationship between the IRS worksheet. I'll show some graphs that bring it all together, and then I'll talk a little bit about implementing all of this stuff that I'm talking about using a computer. So let's jump in. So first, excess of. So excess of is this term that I think the definition is pretty clearly that the excess of A over B is only ever positive or zero. If A is greater than B, then the excess of A over B is equivalent to subtraction, and the excess of A over B equals A minus B, and otherwise the excess of A over B is zero. The thing you see through the paper with this subtraction sign with the asterisk, I always say I'm going to just like dissemble about this, but I actually always end up being straightforward. That's not like a real thing. I made that up. But I figure if I go places and just tell people it's a real thing, maybe people will start using it and then it will just be a real thing. So, but I'm not, be completely honest with you, I just made it up. But I do use it consistently throughout this paper. I use it when I'm teaching. I really like it. It's easier to write accurately. It shows that excess of is just another function or operator like addition or subtraction, but it's not subtraction. So, so I'll use that minus sign with the asterisk a lot. Another way to accurately characterize the excess of A or B is the maximum of A minus B and 0. And for a while, I thought that might be the way that was easiest for me to understand it. Not to me. Okay, so just for example, the extent to which 100 exceeds 40 is 60, and the extent to which 40 exceeds 100 is, it doesn't, 0. So the excess of operator kind of divides up numerical space, where A is on the x-axis in this picture and B is on the y-axis. The space below the line, A equals B, where A is greater than B, in that area, the excess of A over B is A minus B, and in the space on and above that line, the excess of A over B is 0. You can also plot A minus B on the x-axis and the excess of A over B on the y-axis, where A minus B is positive. A minus B equals the excess of A over B, and otherwise it's 0. So when I wanted to show things that involved the excess of operator before I started working on this project, I was operating by cases, because you can see it kind of divides up the space. I would say, well, if A minus B is greater than 0, then, and otherwise this other thing, and this was very annoying, and every time there were nested excess of, I was having to, like, you know, doubling everything. It was real pain. Okay, so I came up with these 3 operational rules to make the excess of operator easier to handle. The article goes through proofs of these, but I'm just going to mention them here. So if A, B, and C are all non-negative, that is, they're all greater than or equal to 0, then these 3 things are true. The excess of A over the sum of B plus C equals A minus B, the excess of that over C. If you have a minus sign and then an excess of, that's the same as 2 excess ofs in a row. And you can push the first sum, you can push it through. I'll completely honest, I don't think I ever used the third one, but it is, I just kind of thought it was cool that there was another rule. And so the paper goes through and proves these, and also I use the computer program to prove these. I'll talk about that more. So with this understanding of the excess of operator, let's now talk about the code sections that rely heavily, some code sections that rely heavily on this operator, which is the law relating to capital gains and losses. As I mentioned in the paper, and I'll just say here, I don't incorporate qualified dividend income into this analysis, and under current law that is treated as net capital gain. And I only look at capital gains and losses for non-corporate taxpayers. So I'm definitely looking at a somewhat simplified version of this. All right, so net capital gain is taxed at lower rates than ordinary income. So in 2024, the highest earners would pay a tax at 37% of their next dollar of ordinary income, but only 20% of their next dollar of capital gain. So very roughly speaking, the idea of net capital gain is that long-term capital gain is subject to this favorable rate, but short-term capital gain is not. That's like a way oversimplification. As we're going to see, short-term capital gain still matters and actually can affect the amount of gain subject to the favorable rate. So, but that's kind of the very rough idea. All right, so net capital gain is the excess of net long-term capital gain over net short-term capital loss. So I'm going to rewrite the statutory language using the excess of operator. I don't think I've done anything there too surprising or controversial. Net long-term capital gain is the excess of long-term capital gain over long-term capital loss. And that where long-term capital gain or loss is gain or loss from the sale or exchange of a capital asset held for more than 1 year. And both long-term capital gain and long-term capital loss are non-negative numbers in this definition. And similarly, net short-term capital loss is the excess of short-term capital loss over short-term capital gain. So net capital gain is defined by 2 layers of excess of, where all of these long-term capital gain, long-term capital loss, short-term capital gain, all of that are non-negative numbers. So we can get some intuitions about net capital gain just kind of inspecting this definition. So for one thing, we know that net capital gain is always non-negative because it's defined in terms of the excess of one number over another number, and the output of excess of is always non-negative. We can get we can understand that both net long-term capital gain and net short-term capital loss are non-negative numbers because they're both defined in terms of the excess of operator. And then we can also see that if there's no long-term capital gain, then there can't be any net capital gain. Because if long-term capital gain is 0, then net long-term capital gain is 0, and the excess of 0 over a non-negative number is 0. So that's just kind of some things we can know just by inspecting this and understanding excess. Another piece of the puzzle is that the use of capital losses is limited. So section 1211B permits the non-corporate taxpayer to use capital losses only to the extent of capital gains plus the lower of 3,000 or the excess of capital losses over capital gains. The general idea of allowing the additional 3,000 is to let the taxpayer use some excess capital losses to offset ordinary income. But the amount allowed shouldn't be more capital losses than the taxpayer actually has, which is why the amount permitted is the lower of 3,000 and the excess of capital losses over. So for example, if the taxpayer has 10,000 of capital gains and 15,000 of capital losses, the taxpayer can use capital losses equal to capital gains, 10,000, plus the lower of 3,000 and the excess of 15,000 over 10,000, which is 5,000. So obviously the lower of those two is 3,000. So the taxpayer is permitted to use capital losses of 13,000. But if the taxpayer has 10,000 of losses, 10,000 of capital gains and 12,000 of capital losses, again, the lower of 3,000 or the excess of 12,000 or 10,000, which is 2,000. So the taxpayer is allowed to use all 12,000 of the capital losses, but not 13,000 of capital losses. That would be like a really weird result. The taxpayer only has 12,000. So that's what that lesser of is doing here. So notice that this loss limitation rule does not mention long-term or short-term capital losses. So a taxpayer with $100,000 of short-term capital gain and $100,000 of long-term capital loss is permitted to use all of the capital loss, but they don't mention here short-term or long-term. So it's commonly said that individuals can carry forward unused capital losses indefinitely. That is true, as the paper shows, but the statute doesn't actually state that in so many words. Now, maybe it's super obvious to you from the statute, in which case that is pretty cool, actually. It was not super obvious to me. What the statute says in section 1212B1 is that if a taxpayer other than a corporation has a net capital loss for any taxable year, I'm going to talk about that net capital loss requirement in a moment, then the excess of net short-term capital loss over net long-term capital gain is short-term capital loss in the next year. And the excess of net long-term capital loss over net short-term capital gain is a long-term capital loss in the next year. So I'm going to write that out using the excess of operator, and then break each of these terms down into their definitions. That is not quite right, though. That's not quite right what I just wrote. Because the term net short-term capital loss and net short-term capital gain do not have the standard meaning given in section 1222, because under 1212B2, to make the calculations in 1212B1, it says you treat an additional amount equal to short-term capital gain. It's the lesser of these two things. So this would be you add on to the amount that's actually short-term capital gain, the lesser of the amount that's allowed under the taxable year for 1 or 2 of 1211B, or something called the adjusted tax, whatever that is. We'll talk about that in a second. So I'm going to call that the 1212B2 amount. So here are the carry forwards written with the 1212B2 amount incorporated. And what I've done there is for the calculation of short-term capital gain, stuck in the 1212B2 amount as it tells you that you should. Okay, so let's just try to develop an intuition about this. Okay, so consider that an amount treated as short-term capital gain for these purposes reduces the loss carry forward. Because if we look at these, 1212B1A permits as a loss carry forward the excess of net short-term capital loss over net long-term capital gain. And net short-term capital loss is the excess of short-term capital loss over short-term capital gain. That means the more short-term capital gain, the less the loss carry forward. And the same thing is similarly is true in 1212B1B. It permits as a loss carry forward the excess of net long-term capital loss over net short-term capital gain. And net short-term capital gain is the excess of short-term capital gain over short-term capital loss. So the larger this number, the more the loss carry forward is reduced. So the more short-term capital gain there is for these purposes, the less loss carry forward there is. So even when losses are permitted, though, sometimes a taxpayer is unable to use all the permitted all the permitted capital losses because of insufficient other taxable income. So that is why 1212B2 treats as short-term capital gain the lesser of the amount allowed under 1211B1 or 2, that's the 3,000, or the adjusted taxable income for the year, where the adjusted taxable income equals the taxable income increased by the amount allowed under 1211B1 or 2, or the exemption, which is currently 0. So for these purposes, the excess of deductions allowed over gross income is negative taxable income. They explicitly say taxable income is allowed to go negative for these purposes. By limiting the amount treated as short-term capital gain to the lesser of the amount allowed under B1 or B2, or the adjusted taxable income, and adjusted taxable income is basically taxable income with the 1211B1 or B2 amount added back, the statute lets permitted but unused capital losses to be carried forward. So let's look at an example of how this plays out. That's also going to bring us to understanding that cliff issue. Here's the example. Consider the situation where all other income except $1,000 is completely wiped out by, say, other losses, standard deduction, whatever. And in addition, there's $6,000 in long-term capital loss and $3,500 in long-term capital gain. So under 1211B, losses equal to the lesser of the excess of capital losses over capital gains, and 3,000 are allowed. And the excess of capital losses over capital gains is 2,500, which is less than 3,000. So all of the 6,000 of the capital losses are allowed. Okay. Net capital loss is the excess of losses from the sale or exchange of capital assets over the sum allowed, but that's 0, they're all allowed. But hold on. Although there is no net capital loss, section 1212B2 operates to permit $1,500 to be carried forward by treating only $1,000, not the full $2,500, as short-term capital gain, and therefore reducing the carry forward by only $1,000, not the full $1,500. It makes sense. So let's see why that works. So 1212B2 says to treat this as a short-term capital gain, the amount equal to the lesser of the amount allowed or the adjusted taxable income. And the adjusted taxable income is taxable income increased by the amount allowed under 1211B1 or B2. So basically what's happening here is that the amount that went unused because there was insufficient taxable income to absorb it isn't considered short-term capital gain and doesn't reduce the carry forward. So net, the carry forward then is 1,500, even though there's no net capital. All right, so let's do this visually. So that's the situation. So let's just first think about, when is there net capital loss? There's net capital loss only when the excess of capital losses over capital gains is greater than 3,000. And the statute says if there is net capital loss, then here are the carry forwards. So the statute says the only time that you can have a carry forward is where there is net capital loss. But what about the situation where there isn't enough adjusted taxable income? There isn't enough taxable income to use the loss that you're permitted. So that's that area that has the circles in it there. That's when the adjusted taxable income is less than the excess losses. For example, there is our 1,000 of adjusted taxable income, 2,500 of excess of capital losses. So the statute seems to say, I think the statute does say, that there's no loss carry forward permitted here because we're not in the net capital loss area. I don't think that's what the statute means. So let's take a look at, I'm just going to break out basically what happens when adjusted taxable income is 0. And I'm going to show you so so adjusted taxable income is 0. What's happening over there? There's no adjusted taxable income. That's our cliff. So there's no adjusted taxable income in this. And according to this picture, there should be no, if we require a net capital loss before there can be a carry forward, then there can't be a carry forward. The carry forward is 0 up to 3,000, because that's when they're net capital. And then all of a sudden at 3,000, it jumps, and everything bigger than 3,000, you can carry forward the excess losses. I mean, I don't know. The tax code does not love cliffs. There's got to be like you know, I mean, you can, it's not impossible, but this just seems like a really weird result, and not what kind of folks must maybe like had in mind. It's hard to think of the policy reason here. So I would suggest that actually probably more what was meant is that actually you could do a loss carry forward in that little triangle with the circles in it, even though there's no net capital loss. The paper talks a little bit about maybe how this came about, this series of amendments that might have caused this situation. I don't think we have to take a view. After some discussion with Professor Letterman, I went into this very strongly. It's a mistake. She was like, calm down. It doesn't matter whether it was a mistake. We can still just say, hey, maybe this isn't what was intended, or this isn't the greatest idea. Like, why would we have a cliff like that? So, okay, I don't have to take a stand on whether it was an error or whether it's just something that's like maybe not such a great idea. So turns out that the IRS loss carry forward form doesn't look anything like the statute, what it requires. So first of all, doesn't look anything like the statute. And the second thing, it fixes the problem with the net capital loss requirement. Call it an error or not, but I think it's a problem. Well, the IRS agrees with me, and they fix it. It doesn't show up here. So this is the capital loss carryover worksheet, and I went through and filled in what each of these different lines were. And it wasn't obvious to me at all that the statute and the worksheet were requiring the same rules, requiring the same thing. But with the rules I mentioned earlier, the pushing through the second sum, it's actually pretty straightforward to show that the worksheet does track the statute, but without the net capital loss requirement. So that's a formalization of what the statute says in the left-hand column and what the worksheet says in the right-hand column. It's like very non-obvious to me that these are the same, but we can show that they are the same, as I do in the paper. And so sorry, I should say they're only the same because of the net capital loss fix. They're not the same if we require net capital. So a little bit about this. This is one example of what Lawsky calls an agency legislative fix. So Lawsky explains in this great paper that she has that legislative drafting is rife with errors, and agencies routinely fix these errors, whether through informal guidance or otherwise. And this paper, I can't recommend this paper enough. It's a great paper. She talks about the significant normative problems with these agency legislative fixes. But she doesn't say they should stop. And I want to be clear that I'm not saying this is a bad thing at all. I don't think this is a bad thing. I think it's awesome, actually. I think it's really cool that the people at the IRS understand things to this level of detail. And I am certainly not advocating that this is a bad thing. And Lawsky also does not say this is a bad thing. What she proposes is that in addition to having some legislative procedural fixes that might allow errors to be corrected more easily, agencies should continue to make these fixes, but should make the fixes more transparent and systematic, including publicizing and justifying these fixes. So there's two aspects to this. One is the legislative fix, but one is even if the statute didn't have that net capital loss requirement. So even if this weren't a fix, I would say there's still something going on here because this algorithm isn't transparent. So let's just say there's no fix at all. Let's say it was exactly the same, that there's no net capital loss requirement in the statute, no fix needed, no problem. Still, I would say that it would be really helpful to have a justification for this because the algorithm as they have it is not transparent. It doesn't track the statute at all. Someone inspecting it could not easily back out the motivation behind each of the parts. The IRS hasn't provided a justification of this algorithm. You have to just trust that it's correct. But I'm not criticizing the algorithm. I think it's amazing. It's incredibly efficient. It's short, and here's the part that's so cool. All of the inputs are pre-calculated. Nothing needs to be recalculated to use this algorithm because all of the inputs are also generated for the net capital gain algorithm. And the worksheet just says pull information from just a few lines of another schedule, the Schedule D. So the way the statute puts forward the algorithm in that left-hand column, the taxpayer would have to recalculate net short-term capital gain and take into account the 1212B2 amount and all this. But the algorithm on the worksheet extracts the 1212B2 amount. So the taxpayer can just take the two non-zero numbers from the Form 1040 and then together with the 1212B amount, determine the carry forwards. It's really kind of beautiful. So the worksheet doesn't provide a formula that obviously tracks the statute, but what it does provide is very easy to implement. an algorithm that tracked the statute closely would be way less efficient, and even that algorithm would be opaque to almost all taxpayers. I'm not overestimating what people would be able to understand. So what am I proposing? I'm just proposing that an IRS provided write-up of the form and the worksheet describing reasoning like the reasoning I put forward in this paper, that alone could address concerns about the agencies, both the change in the law that they made and the lack of transparency of the worksheet. So that would be in line with Lawsky's proposal for increasing transparency around legislative fixes. And it would also just make the algorithm more transparent, because it would connect the algorithm of the worksheet with the language of the statute. And it could do this while allowing continued efficient implementations of algorithms that are presented on the current form and worksheet. I really want to be super clear that I have whatever, like the opposite, I'm praising their worksheet. I'm not criticizing it. I'm just suggesting that having an explanation of the reasoning that led there would increase transparency. So the other thing that I do in this paper is I just try to bring together all of these different rules into literally one picture. So I put, because as I mentioned before, the carry forward loss, the loss carry forward does not talk about long-term or short-term capital gains. And so it might seem like it's kind of like floating out there unconnected to the rest of what's going on. That's just not true. Actually, all of these statutes fit together in one picture, which I don't know. I'm very impressed by whoever drafted these statutes. So let me just talk about that picture a little bit. So on the bottom is long-term capital gain minus long-term capital loss. It's not excess of, it's really minus. And on the left-hand side, the y-axis is short-term capital gain minus short-term capital loss. So the circles there are where there is net long-term capital gain, because there the long-term capital gain minus long-term capital loss is positive. The hash marks are where there is net short-term capital gain, because short-term capital gain minus short-term capital loss is positive. So we can kind of put those together. And then actually we can see where there is going to be short-term capital loss, where there's going to be a loss carry forward, where there's going to be net capital gain. This isn't quite right. It doesn't take into account the 1212B2 amount, but we can just shift that line over and take into account that extra 3. All right, so that just kind of helped me develop some intuitions around the statute. So what is, to me, a very interesting aspect of this is reasoning like this can actually be done computationally. So what I did, as well as doing this by hand, I went ahead and wrote the formalizations into computer code, and specifically I used a theorem solver. It's something called Z3, and in which I was able to write the Z3, and then you can write it in a bunch of ways. I wrote it into Python programming language. I just brought over the formalizations and put them into this language. And what Z3 does is it looks at sets of logical formulas with certain constraints and sees whether there's a model that can satisfy all of those formulas. And so for all of the stuff I did in the paper by hand, the proof-like stuff that I did by hand, for the excess of rules, and also for all the capital gains verifications, I was able to go ahead and do that using computer code as well. And this could all be done using computer code by agencies as well. It was very straightforward. You can go, if you want to see all of the code, it's up on GitHub. You can go and see, it's like all of the code is, a couple hundred lines, and the only reason it's a couple hundred lines long is because there's so many comments in it, as I was just trying to explain. But the code itself is very, very brief, very straightforward. So this is the paper that started out to be about excess of and ended up being this. Essentially, this was the last part I did. So that was it was kind of fun to realize that this paper that I thought was about trying to figure out something about something very specific about some language in the Internal Revenue Code was actually completely in line with all of the rest of my papers that I write, which I guess that's not too surprising because I'm just one person and I only apparently have one set of interests. But I think there's a lot of potential here. So we could have computational reasoning like this that formalization allows. It can help verify where can we use this? You could use it at the drafting stage to help verify that drafted statutes are consistent with what the desired outcomes are. You could identify problems in the statute if they did get passed that agencies needed to fix. It can be used to help verify that the agency implementations are consistent with current law if nothing needed to be fixed, or with the desired outcome if it did need to be fixed. So I think there's a lot of potential for formalization. I always think that, but I think there's formalization that allows this kind of computational reasoning. So those are my prepared remarks, and I am really looking forward now to questions, discussions, comments.